Hello traders. In this video I'm going to be describing a workflow process that I use as a basis for developing a diversified portfolio of systematic trend following expert advisors using two powerful development tools, namely Strategy Quant X, which I use to develop individual strategies, and Quant Analyzer 4, which I use for the portfolio compilation process. So this demonstration will provide an overview of this workflow using 21 popular Forex markets that are readily available to the retail trader. But the principle of this workflow can be universally applied across any liquid asset class. Of course, in our retail world, we face a significant hurdle in our ability to diversify due to our limited available trading capital. But thanks to microlot offerings by many retail brokers today, we now can achieve significant levels of diversification, and having this ability using relatively small levels of capital now allows us to mimic the techniques of successful professional fund managers that have demonstrated a long-term track record deploying systematic diversified trend following and momentum models. Ideally, through this particular workflow process, we are seeking diversification of two forms, namely market diversification and system diversification. Diversification is a necessary prerequisite for divergent models such as trend following and momentum, which allows us to capitalize on the edge provided by market uncertainty, where price has a tendency to diverge away from a prior equilibrium. This is unlike convergent models, which capitalize on certainty or repeating patterns that oscillate about an equilibrium. Convergent models, unlike their divergent cousins, benefit from concentrated as opposed to diversified methods. So, in our divergent models, diversification is a method we adopt to provide capital preservation benefits while waiting for the unpredictable trending anomaly to come our way. Diversification ensures that we do not put all our eggs in one basket and allows us to reduce our risk exposure to any particular individual return stream. This ability to offset risk and preserve capital is a necessary prerequisite when trading a portfolio of divergent strategies that seek to exploit market behaviour associated with uncertainty. So, too much exposure to any particular asset class or return stream will create risk weakness in our portfolio that could lead to excessive volatility and even risk of ruin if not carefully managed. So market diversification allows us to spread our wings far and wide across asset classes as we are seeking less correlated relationships in the market data. So in terms of market diversification, we would be looking at applying this workflow process beyond a single asset class such as Forex to include diversification into equities, cryptocurrencies, agricultural commodities, non-agricultural commodities such as metals, bonds and fixed income instruments. Now fortunately in our retail world we can now achieve a far greater degree of cross-asset diversification using contracts for difference or CFDs that give exposure to these underlying asset classes in both mini-lot and even micro-lot form. But just keep in mind that for the purposes of this video we will simply be compiling diverse portfolios within the Forex market available to our broker, which in this case is Pepperstone. In reality, however, we would be seeking to extend this workflow process across additional asset classes, and we would achieve this by including additional brokers who offer CFDs within those additional asset classes. Two good broker sources that provide very wide diversification across CFDs include IG Markets and AvaTrade. System diversification is now becoming increasingly important as a method to reduce the observed building positive correlations between asset classes. Over the last decade, it has been clearly evident that diversification benefits from cross-asset diversification is now lower than what it used to be. So in today's competitive marketplace, we need to look at ways to force lower correlation into the classic trend following portfolio. And we do this using system diversification, where we are looking at compiling a range of different trend following models into a single trend following portfolio. Each trend following model has different entry conditions and trailing stop conditions built into their design, which allow us to target a broad range of different trends and trajectories, and also reduce the degree of correlation between individual return streams of the portfolio. The trends of today tend to be more volatile and less clean-cut than the trends of yesteryear, and from our research on the nature of the trending condition, we can clearly see that the trends of today have a lower signal-to-noise ratio than they previously did. This increased market noise and tendency for mean reversion interferes with the trend-following signal, resulting in the need for a far more diverse array of trend-following solutions to tackle the messier class of trends observed today. And having a diversity of trend-following systems in our portfolio allows us to tackle a broad class of different trending condition with different trajectories. Now, before we progress into the workflow process itself, it is important that we first have an appreciation of the design considerations that we want to force into each solution generated by the workflow, to specifically target the opportunities that we believe are available in the market data. So before we commence any data mining process, we first need to therefore have a clear understanding of the edge that we are attempting to exploit, as this dictates the design considerations that we need to embed into each one of our algorithmic solutions developed by the workflow process. In other words, we need to first have an understanding of the market behaviour that we are attempting to exploit through our trading model. So in this video, we are seeking to exploit those opportunities where price trends tend to persist. In other words, the edge we are targeting relates to a sustainable advantage over large trade sample sizes where prices tend to trend more than what a random distribution of market data would imply. Without first having a clear understanding of the edge we are intending to target, it can lead us into murky waters where our workflow process generates its own solutions that we simply cannot decipher or understand in terms of their trade logic. We therefore want to enforce design logic first into our possible solutions, right from the get-go. This requirement to restrict our workflow process to meet core design principles is what we refer to as a design-led process. Having an understanding of the edge that we are attempting to exploit enables us to first ensure that all our designs logically respond to this targeted edge, which can then assist us in troubleshooting down the track to identify when our model is either performing or is not performing. For example, in relation to trend following models, we need to map our trading performance against the market condition, and this process is called mapping to the market, and is used to tell us important information on whether our models are working or not. So when markets are clearly trending and our algorithms developed by our process performs well, then this is a good sign and suggests that our design specifically responds to a particular market condition, in this case a trending environment. We can easily see this logical relationship when we see trending market data and can confidently assume that our EAs will also perform well under these trending conditions. If markets are not trending and our algorithms are entering drawdowns, then this is also to be expected, as it is not a sign that our systems no longer work, but is actually a necessary symptom arising from when trading market conditions are unfavourable and conditions are not trending. However, if markets are not trending, yet our algorithms are still performing well, or if markets are trending and our algorithms are not performing well, then we know that there is a problem in the way we tie our design logic to the market condition. And in those instances, there is every chance that our EAs have actually been detrimentally curve fit to the past market data. So a design-led approach to our workflow process starts with core design principles first that specifically respond to a possible market condition, and then we use our workflow process as a basis to diversify around these core design principles. So for the purposes of this video, we are specifically targeting trending market conditions. Our hunt for the trending market condition is focused towards the left and right tails of the distribution of market returns. So let's have a look at what we mean by this fat-tailed statement. The following chart provides an illustration of typical distributions of daily market returns found in most liquid markets. And we plot the daily returns in a histogram format by virtue of their relative frequency from large negative daily returns on the left to large daily positive returns on the right. And we can see that the majority of daily returns in this specific example are centered around the 0%, which is the mean of this distribution in this case. And this is typical of, say, the Forex market that has no preferred directional bias. But for equity markets over large samples, we might find there is a slight positive bias in the overall market data, where the mean of the histogram is situated to the right of the 0% range, which therefore skews the distribution to the right. But in this Forex example, if the market data was normally distributed, or we refer to this as a Gaussian distribution, we would expect to find that approximately 68.5% of the returns would plot within a plus or minus 1 standard deviation away from the mean, and at 2 standard deviations we would expect to find approximately 95.4% of the daily returns residing within this zone of the distribution. And we would therefore be able to plot the histogram within the region defined by this blue curve, which is a curve which is a result of a normal distribution. But as we can see in this particular sample data, this is actually not the case, which is very fortunate for us speculators, as it gives us hope that there are actual inefficiencies in the market that we can exploit. Now, a normal distribution is a distribution we need to worry about as a speculator, as this form of distribution defined by this blue line is a plot of purely random market data that carries with it no sustainable trading opportunity. Under a normal distribution, markets are referred to as being perfectly efficient, and the resulting histogram of market data is what is to be expected in trading pure randomness. In other words, if we find that the market distribution of returns follows this normal distribution defined by this blue curve, then there is actually no sustainable edge to exploit. And under a scenario of trading effective randomness, we may be lucky or unlucky over the short term, but as our trade sample size increases, we would find that we actually held no definitive edge in the market at all. So as traders seeking an edge, we need the market returns to plot a non-normal or non-Gaussian distribution profile over the longer term. And fortunately, under real market conditions as displayed in this graph, we find that the market data does not strictly obey a normal distribution and exhibits departures from normality that is more like a Cauchy distribution. Under real market conditions, we can find that at times the distribution of returns possesses positive or negative kurtosis that lead to excess returns that extend beyond the envelope of the normal distribution into the peak of the distribution, defined by this circle here, which suit convergent trading models, or to the left and right of the market distribution, which suit divergent models. Now, having an understanding of where your edge resides in the market distribution of returns, therefore, is critical, as it defines whether you need to apply a divergent or convergent trading style to respond to this edge. Convergent trading styles, such as mean reversion, target the edge residing in the peak of the distribution and suit concentrated strategies where entry conditions and the application of profit targets are essential, whereas divergent trading styles, such as trend following or momentum methods, target the edge residing in the tails of the distribution, where entries are far less important and trailing stops are preferred to define profit targets. The methods deployed to trading convergence or divergence are the exact antithesis of each other, so it is best to treat them separately and not jumble them up. In this particular video, we are only focusing on divergent methodologies that can be compiled into a diversified systematic trend following portfolio. So let's refer back to that hypothetical plot of market returns. There may be times when market returns can lie in the tail zones outside the range of that normal distribution. And typically in these exotic extreme zones, traditional rational trading behaviour associated with more normal market conditions is replaced by coordinated mass behaviour associated with fear or greed, which can lead to significant market undershoots and overshoots that lead to these tail phenomena. It is within these extreme trading zones that trend followers tend to blossom, as their models allow for unlimited upside with strictly managed downside exposure. The algorithms that we will be deploying are therefore based on divergent trading principles that cut losses short and let profits run at all times. Unlike convergent trading models that assume that markets tend to oscillate about a historic equilibrium, which is typical of the peak of the distribution of returns, divergent trading models exploit those times when markets are in disequilibrium and trending away from historic equilibriums towards new equilibriums. Divergent models therefore are specifically designed to operate during more uncertain and less predictable market conditions. REAs are models that adopt the assumption that over extended periods of time, all liquid markets can express fat-tailed behaviour where trends in a price series using a large trade sample size exhibit a degree of divergent persistence. Our models are developed on the assumption that this slight divergent persistence, combined with a method that always cuts losses short to preserve trading capital, will, over a sufficient trade sample, provide a sufficient edge to allow the principles of compounding to generate long-term wealth-building returns. Now, before we commence the workflow process within Strategy Quant X, we first want to be clear on the design rules that need to be addressed by our development processes that allow us to confidently target the fat tails of the distribution of market returns. The rules that we will be applying in this video series are as follows. We will be operating off the daily time frame only. According to our research, trend following models that target the tails of the distribution tend to work better off the longer term time frames. Each algorithm will apply a rule that cuts losses short at all times, and in this workflow process we'll be using the average true daily range as our method for stop loss placement and trailing stop placement and activation. ATR based methods allow us to deploy multi-market testing techniques that normalize price volatility across different markets. Furthermore, ATR-based position sizing allows us to scale our trades in accordance with recent volatility. In periods of high volatility, position sizes will therefore be smaller than during periods of low volatility. We'll also be deploying a 1% trade risk on available equity for each trade undertaken by the strategy. As equity declines, the dollar risk allocated therefore declines per trade, and as equity builds, the dollar risk applied to each trade increases through this percent trade risk methodology. The method allows us to benefit from compounding if we find that our portfolio progressively increases in equity over time. We will also not be deploying profit targets in our solutions, as we are targeting fat-tailed moves that could be of any duration and extent. ATR-based trailing stops will therefore be our method to exit a trending condition. We will also be applying a long-term look-back for our trend-following entry indicators to act as filters that therefore restrict our trading activities to these more exotic market regimes. This approach will therefore bias the process to generate solutions that respond to more extreme market conditions as opposed to the normal day-to-day churn of price activity. We will also be developing both breakout models and other forms of trend-following model to ensure that a variety of different trend forms are targeted. Breakout models are essential for our portfolio in a fat-tailed environment, as they ensure that no major price move of significance are missed. To miss a major trend is regarded as a sin for the trend follower and referred to as a type 2 error. But by including breakout methods in addition to other forms of trend following model, we ensure that we therefore catch all major moves of significance, but also achieve wide system diversification benefits through the inclusion of numerous other trend following models. So now that we have determined our design rules, we are now ready to proceed into Strategy Quant X to configure the workflow process. But as time is getting away from us, it's probably best to leave it here for now. So stay tuned, traders, for the next episode that I'll be producing shortly, and thanks for watching this video. In our next video, we will get straight into the strategy development and data mining processes that we use in Strategy Quant X to do all the heavy lifting and streamline what otherwise would be a very long-winded and time-consuming process. So take care and trade well.